My name is Ben Hron. I am a partner in the corporate practice group of McCarter English, and I focus my practice on startups and venture capital. So I'm really pleased to be joined here today by David Beisel to talk about raising seed capital. David is a co-founder and partner at NextView Ventures, a seed stage venture firm based in Boston. And he invests in NextView invests in startups that are changing the everyday economy. And I'm going to let David explain what that means in a second. In addition to investing, David and his partners in NextView have a blog that covers a range of topics related to entrepreneurship and raising capital, which I would highly recommend to anybody who is, in fact, an entrepreneur, that you check it out. It's really a wealth of information. So with that, we're going to talk for about an hour here. If you have questions, please either post them on the chat on the Zoom chat or post them on the Slido chat. I'm monitoring both, and we'll try to get to questions as we go through. So with that, David, can I just ask you to talk a little bit about yourself and NextView, and then maybe give us your view of the current state of the fundraising market for seed capital?
Yeah, so as said, David Beisel at NextView Ventures. We are a seed stage venture capital firm. We have offices here in Boston as well as in New York, but we invest throughout the country. We're investing out of our fourth fund. It's an $80 million fund. And we invest in companies, as you said, which are changing the everyday economy. And what does that mean? That means we're looking to invest in companies which are taking best-in-class technology and then applying it to people's everyday lives. So about 60% of what we do is consumer-facing, and then about 40% of what we do is B2B, but it's enabling layer technologies which help transform a consumer experience at the end of the day. We'll invest, and we'll get into this in a little bit. We'll invest across the broad range of seed. So in the last 18 months, I've invested $200K into a $400K round, and it was two people, a dog, and a PowerPoint plan. And on the other end of the spectrum, I've invested. I wrote about a $2 million check into a $5 million round. It was an e-commerce company. They are doing $500,000 a month in revenue. That's also called a seed round these days. But the typical for us is us writing $1 million check, $1.5 million check into a $2 to $3 million round total. We have a bias towards either leading or co-leading rounds and helping catalyze rounds come together. And then we take a really active role with our companies once we make the investment, typically taking a board seat or an active board observer role. And without making it too much of a commercial, I'll put a link to it as an approach page where we believe that we see that entrepreneurs are often pitching VCs. At this link here, we have a pitch deck to you as entrepreneurs to explain what we do, because we think it's a two-way conversation and an even playing field. And then, I'll pause here in a second, but, my own background, think Web 1.0 era. I co-founded an email marketing company, which we sold to About.com. So I ended up working at About.com for a couple of years as VP of marketing. And then I got on the investing side and started NextView about 10 years ago.
All right. And so what are you, seeing in these crazy times? How's COVID and affecting what you're doing right now?
Yeah. So I would say March, April, May, everything just froze up. It was, our firm and, I think our peer firms, we told all the entrepreneurs in our portfolio, if you don't have to raise money, don't go out there and fundraising. We were also trying to assess, okay, how is this landscape changing, our portfolio companies, and how is it affecting our portfolio companies? So we had less people kind of knocking on our door, and then, there's just less kind of going through the whole kind of investment process. It quickly, along with the public markets kind of reopening as well, or kind of going back up as well. Entrepreneurs kind of in the summer, we started to see more folks starting to go out fundraising. And, it wasn't until kind of just the beginning of September that we even recommended for entrepreneurs in our portfolio to start, testing waters to go back out again. So I would say it is at a level that's much less than it was call it a year ago, but we're at above a level of, who's complete frozen what it was in the spring.
Are you seeing a change in the focus of entrepreneurs or what you're interested in investing in, industry focus, different types of technology?
A couple thoughts there. I think for us in general, we go back to this kind of grounding principle, which I talked about investing in things that affect people's everyday lives. And so for us, that part hasn't changed. And I think most venture firms, whatever their kind of broad thesis is, hasn't really changed. I think we've seen two different kinds of new opportunities that are interesting over the last, last couple months. One, we've seen, I would call it kind of direct reactions to COVID. So we've seen a lot of pitches around, UV lights that kill pathogens, or, air filtering and things like that. That for us at NextView, like something that's direct reactionary is less interesting to us. I think there are kind of probably short to medium term opportunities that some folks are pursuing. What's been interesting for us is we've seen, I think, a number of things that we predicted would happen in the future anyway. We talk about a phrase internally about the future is now being pulled forward because of the effects of the pandemic. And so that's everything from, working remotely to even some telehealth and telemedicine, and to even just greater adoption of e-commerce. I mean, I just think about your own, I suspect you, and I know in our family, we're buying everything online now, whereas, it was some retail before. And so we at NextView think about, okay, what are those areas where the future was going to happen anyway, but it's just been pulled forward because of the effects of the pandemic?
Yeah, that rings true. If I really were to think about what I should be investing in right now is cardboard boxes. Whoever makes cardboard boxes, because we get so many of them on a weekly basis.
You joke, but I mean, we have seen pitches which is actually, it's pretty interesting, about like recycling containers and packaging materials and things like that, because of that and trends towards sustainability as well.
Yeah, and also you get things that were old or new again. I mean, meal kit services like Blue Apron have suddenly started doing a lot better again.
Yeah.
So yeah, it's having an impact. What about actually sourcing? I mean, I'm sure you get a lot of inbound traffic, but it's harder for you to go out and find companies. And then regardless of where the source comes from, you then got to have an interaction, and it changes the dynamic to just frankly be Zoom chatting with somebody as opposed to be sitting in the room, being able to sort of look them in the eye. How are you dealing with that?
Yeah, so I mean, for us, we source our opportunity. At NextView try to embed ourselves within the entrepreneurial community. And so most of the investments which we make, we've known the founders for greater than 6 months, many times it's years ahead of when they're actually fundraising. No, that's not all the time. And so, some of those relationships, predate obviously the pandemic. That being said, I think we, as well as a number of our peers, we've started to get comfortable with, I would call it a virtual only investment decision. So we've made 5 new investments since March, 4 of those out of our new fund. And 3 of those were ones where we did not know the entrepreneur before. And we were able to spend time on Zoom and make an investment decision. I think we ended up doing more kind of back channel diligence work and talk to just that incremental additional reference or two to really understand, what the founder and the founder's team's strengths and weaknesses were before we made that decision. But for us, it was something that we got comfortable with fairly quickly. I think different firms have had different thoughts on how they've been thinking about it. Have
any of the investments you've done since the start of the pandemic been teams that came together after the pandemic started? Because one of the things I wonder is, if you're trying to find a co-founder, in this environment, it's even harder than it used to be.
Yes, let me try to think about that. One of them was the team came together, but they knew each other before. So I think it seems like forever. We've only been in a pandemic for 6 months. And so there are, there's relationships that were before. The one other thing we've done, and not to give too much of a plug, but we launched a 100% virtual accelerator program earlier in the spring. And so, we put out the call nationwide for folks to, apply and join a 100% virtual accelerator. The first cohort we stood up in starting in June. We had companies actually here from Boston join, but we had companies from all the way from California to even Alabama. And it was a broad range of industries. And so for us, that was another thing we wanted to try to do to kind of put ourselves out there during, these atypical times, is do something that, allows us to start a relationship with entrepreneurs through an accelerator program.
Yeah, so that actually raises another interesting issue, which is geography. I mean, the old adage used to be basically that you tried to invest in things close to home where you could basically go visit the company and whatnot. But that's obviously changed over the years. But I imagine it's sort of accelerated here, because now it doesn't really matter whether they're in Boston or not. You have no more ability to see them, at least initially, than you would anywhere else. Have you seen that happening? Has that changed? Have you been looking at investments further afield because of that?
Yeah. How do I think about it? I think in general over the last decade, yes, historically, the earlier the stage, the more a local game it was. And I think to the most part, that's still mostly the case. But I would say over the last decade, just like the world is flattened in so many ways, I think that's been the case as well. We as a firm think about our percentage of, we started the firm here in Boston, and over the last decade, the percentage of investments we've made outside of Boston has gone up over that time, and I think that's fairly reflective of the kind of professional seed stage VC ecosystem. I don't know. I think it's too early to tell. For us, it's a little too early to tell how much kind of the effects of the pandemic will really, accelerate the kind of geographic distribution. But to your point, like if you just think about the reasoning behind it, I mean, of course it should, right? I mean, whether I'm meeting someone in Boston or meeting someone somewhere else, like it doesn't matter. We're over Zoom. Yeah.
Okay. It's crazy. So just shifting gears a little bit from sort of the general state of things to the process. What's your advice to an entrepreneur who's has an early stage company, hasn't raised any institutional capital yet, and is starting to think about starting to think about a raise? And what are the things you look at? Obviously, you need to think about how much you need to raise. You need to find the right investor. It needs to be the right timing, but right valuation. What would you say to an investor who's sort of in that situation about what they should think about before talking to you?
Yeah, so maybe I'll take a step back and the one thing, regardless of whether it's professional investors or angel investors, whether sophisticated or non, like all investors, and this goes for I think public market investors as well. Like all investors make decisions with their heart and not with their head, right? At the end of the day, you can do the analysis in your head, but at the end of the day, you're making a gut decision. Like, do I want to, if it's a public market, do I want to just buy the stock? And then for early stage investor, it's do I want to make an investment in this company and be a part of the journey over the next 10 years? And when you think about it that way, it is a gut decision, not just a head-driven decision. And so when I think about, okay, what should entrepreneurs do? It's how do you appeal to people's hearts, right? And the way you do that is through a story or a narrative. And so when you're looking for investors, I think about who's going to either understand that story or narrative. Is it somebody that has a prior experience in the same space that your company is in? Is it someone or a firm that has prior experience with a similar product or similar customer set? Or many times is it someone who has prior experience, working with you, right? And so that's where relationships get driven in. And so, I think the first thing to think about when fundraising, regardless of approaching us at NextView or another seed venture capital firm, or any investor, is like, well, how can I craft the story around my company, not just the facts, so that it appeals to that individual and that firm because it fits into whatever narrative. I don't know if that answered your question exactly, but that's the first thing I think about.
Okay, and what about the mechanics of reaching out? I mean, I would think that right now, since nobody's going to run into you at an event, yeah. Warm introductions really become pretty critical.
Yeah, so when I think about introductions, there's lots of debate I think about, like how warm an introduction do you want and how much time should you spend? I think, let's see if there's a spectrum here. I think a weak warm introduction is the best introduction unless you can get a super hot one. If you get a super hot one, oh, I've known this person forever, they're the best, and I know that person really well, like I'm gonna really, really, really pay attention. Otherwise, it's just, it doesn't matter if the introduction is somewhat warm or a little bit warm or medium warm or lukewarm. Like if it's coming from somebody I know, I'm gonna pay attention. So I think sometimes entrepreneurs worry a little bit too much about, all right, should I get an introduction from here, for there? It's like, you just wanna get in to the email inbox that they pay attention. And then at that point, it's not about who the introduction's from. At that point, it's do you fit into the, can you tell your story in a way that's effective, that's going to grab their next level of their attention? I mean, as you might suspect, in my email inbox, I get unsolicited emails, literally dozens a day, that it's just tough to sort through. I personally, I don't think all my peers, but I personally do read all of them. And we have made an investment. I've made an investment. We can talk about it if you want, of a San Francisco-based company that was completely a cold email outreach, but it was so personalized and so tailored to my background and the firm's investment thesis that it was clear. Again, this goes back to the story. It grabbed me here, not just here, because it fit into their story, fit into what we were looking for. If that makes sense.
Yeah, totally.
But other than that, it's easy. Get a lukewarm, or get a barely warm. Get
somebody, right? Somebody that isn't going to get thrown to somebody that sent an email that isn't going to get thrown to your spam filter.
Yes.
And what are sort of the first cut of just no? I mean, other than ideas that are outlandish, what is it that you look at? Because, like you said, you get so many unsolicited emails. There has to be some process of trimming it down because you can't do a deep dive into all of them. Yeah. What are the key things that you look at and go, you know what, this just isn't, for whatever reason, we're not even going to dig any deeper, even if this might be a good company.
So not just the first filter, but even all the way to the decision making. I and my partners, we look at three things. So the first thing, we look at team. And it's just that, it's team. I think we've invested over the last decade in 90 odd companies. I think 87 of them have been founding teams, not individual solo founders. So it's team. And what we look for a team, it's less about years of experience, but what we look for we use the word internally authenticity. And what that means is, does the founding team have a unique set of experiences that gives them an unfair advantage as to why they're starting the company? And then does it give them an unfair advantage as to why they're going to be successful? And so, we've backed all the way from serial entrepreneurs on this side to, literally college kids in their dorm rooms. And, in the latter case, that I can think of one specifically, he didn't have a lot of years of experience, but the things that he had been proactive about doing demonstrated the fact that he was going to have an unfair advantage to be successful. And it's actually one of our more successful companies in our first fund. So anyways, that's team. So the first thing we look at is team. The second one is market. And, is this an attractive market for us? And part of our thesis around everyday economy is, hey, where are some of the biggest dollars spent within, consumer expenditures? If you literally look at Bureau of Labor Statistics, the top, I think, 7 categories are food, transportation, apparel, home and housing, work and money, health and wellness. I mean, those are big markets. So we're looking at big markets. And so is it in one, that it doesn't have to be necessarily verticalized, but is it in a big market? And then lastly, product. And I use the word product kind of loosely in that it's like, what's the current incarnation of the business to date based on the time and resources which have gone into the company, right? If the company's a month old and, you were able to stand up an MVP already, you're like, oh, that's pretty interesting. If you've already have $1 million of friends and family into it, and you've been working on it for 4 years, and all you have is an MVP, well, maybe something's not working right? And so, to some degree, and I think most VCs kind of grade on a curve, so to speak, based on the time and resources that have gone into the company to date.
Okay. So we're starting to get some questions, and I'm going to try to hit a few of them. One came in on point is, do you invest in teams that have not worked together before or for very long?
The short answer is yes, absolutely. And I think we identified that as it's a risk, and sometimes we try to pressure test that. In those cases, we try to spend time together as not just with individual team members, but spend time with the team. Now, obviously, that's harder on Zoom, just to see what the subtleties and the interplay, the dynamics are between the different team members. But so that is absolutely something we do. And we look for, the other thing I'd say is we look for teams that are comprised of individual members that are complementary to each other. Based on what their backgrounds are.
Are there any particular criteria you use for evaluating how a team is dealing with the pandemic? I mean, are you just looking for, their interactions on Zoom, or is there some deeper dive?
I'd say often we will do both front channel and back channel references to find out how this person has worked well or not well on other working teams that they've been involved with.
Okay, fair enough.
Yeah.
And so, once somebody gets past the initial cut, are you having Zoom meetings with people? Are you asking them to send you slide decks? Are you looking for one-pagers? What's the sort of stepwise process that somebody goes through to get up to an investment committee meeting?
Yeah. So I would say next we talk about our process being days to no, weeks to yes is kind of the timeline. We try to be very respectful if it's not going to be a fit, to let folks know that. In terms of process, if there's, if an introduction comes in and, it's intriguing, one of us will meet with the founder on Zoom. Usually it's an initial 30 to 45 minute meeting. Most often, but not always, the founder has a short presentation deck that they ended up presenting. I personally like it when entrepreneurs send that in advance. I personally take the time to read those in advance, and so because I'd rather have I'd rather have it as the backdrop, and then use that as a way to have actual real conversation, as opposed to just kind of sit there and lean back and the entrepreneur presses play and kind of walks through the presentation. But different entrepreneurs, different styles, and candidly, different VCs have different styles. And then from there, it's, I think the purpose of that first meeting for founders and entrepreneurs is not to get the investment. The purpose for the first meeting is to get another meeting. And you want to kind of get a VC on the hook to then say, okay, this is interesting enough that of all the other things that are on my plate, I'm going to prioritize this within my time. And really kind of pursue it. And so a next step might be another phone call with that same partner at the VC firm. The next step might be meeting a different partner at the VC firm because, the original person I got introduced to wanted some, a second opinion or, some critical feedback, or here are the things I think are interesting. Here are the things that I think are risk factors. Or it might be if there's already a business up and going that there are metrics, sometimes there are metrics you can dive into. Sometimes we'll ask for whether it's financials or other usually it's more operating metrics or marketing metrics, just to get a better understanding of what the business is to date so we can get a point of view as where we think it can go. And so I think along the way, there'll be, over the course of weeks, successive meetings, and to what you alluded to, which is kind of the final kind of partner pitch. And just like most other VC firms, we end up doing ours on Mondays, where all our investment team, we as an investment team get together every Monday anyway for a couple hours to talk about new potential opportunities. We talk about our portfolio companies. We talk about the operations of the firm. And at those meetings, we also have entrepreneurs come in and give a pitch. And those companies are ones where they're one of the partners is really a sponsor and saying, this is something I'm really interested in at this point. This is, this is what I'm excited about, and I want feedback from the whole partnership. And usually if a company kind of passes that kind of stage, that's when, the next stage of the process goes, we'll either, initiate a term sheet and kind of go from there.
So I want to talk about term sheets in a second, but we've got a couple more questions sort of about the earlier stages in the process I want to try to get to. A couple of questions around solo founders and how you look at solo founders, and if they do come in as a solo founder, do you help them try and find a co-founder? Do you encourage them to find a co-founder? What is, how do you approach that?
Yeah, so what I'd say is a founder and a CEO's job is to be a Pied Piper, right? Your job is to attract customers. Your job is to attract people to work with you, and your job is to attract capital. And so what we see a solo founder, the first test is, can you attract other people to join you on this journey? And so if we meet a solo founder that we're very compelled by, we do try to help them in that process in finding another founder. Depends on how excited we are, whether we do that in a formal fashion or kind of informal, and I don't see it as there's kind of lots of gradations in between. But again, it's very rare, less, just a single digit percentage points of us making the investment with it just being a solo founder before they've actually, been able to attract others to join them.
And do you have, again, just a question from the audience, do you have any revenue expectations at the investment stage?
No. So what I would say is, I'd say probably for us, about a third of our investments are kind of pre-everything, pre-product, pre-launch, pre-revenue. A third of our investments are post-product, and there's something in the wild, but there's de minimis revenue at the time. And then a third of our investments are, there is a product in the wild, we have customers, and there is revenue, and there are some kind of metrics up and to the right. So 2/3 of the time, these companies are pre-revenue or pre any meaningful revenue, really.
What are some companies that you maybe see as potential but not quite there yet? Do you sort of lend a helping hand there and try to encourage them along, help them along to the point where hopefully they would be appropriate for an investment?
Yes. I mean, in those cases, first, I think we're very direct with the entrepreneur. Hey, we say this is not a no, this is a no, not yet. And we try to do just that. I mean, we try to first and foremost build a relationship with that entrepreneur, so that when they do progress with their business and achieve additional milestones that are proof points to investors like us, that we earn the ability to see the investment opportunity again. So I think that's the first thing. The second thing is we try to be helpful, and whether that's trying to refer customers, it's a B2B company, or often employees, or whatever other ways that we can be helpful to try to build that mutual relationship of trust. I'd have to think about the exact percentages, but there's a good number of our investments that we've made where, as I said, many of them we've known the founder for many months and even years before, and in some of those cases it's because our original answer was not no, but the original answer was no, not yet.
Right. And when evaluating a team, do you look at ancillary players, advisors, for example?
I pay less attention to advisors. I think advisors can be helpful, but they're advisors. I think at the seed stage, there's too many calories spent trying to find the perfect advisors, and too much airtime in pitch decks going through them. I'm not to say that advisors aren't helpful, but if you convert those advisors into angel investors, that has signaled that they really do believe and they are going to be committed. So if you tell me XYZ is not just an advisor, but an angel investor as well, then that's what I put a little bit more weight into it.
In evaluating the company, does the cap table ever become an issue? And you mentioned angel investors. There's now a company called crowdfund for seed round investments. Does that ever become a sticking point?
So what I would say is, philosophically for us, we decide, do we want to be investors in the business first with the entrepreneur? And so and mutually, does the entrepreneur want to be in partnership with us? And then we figure out whatever the deal is later. And I think that's just our philosophy, and that's how we think about things. Almost all of the time, if we choose the entrepreneur, the entrepreneur chooses us, we can figure out a way, given whatever structures have happened in the past and angel investors, or whatever has happened in the past, to figure out a deal that's going to work. That's not to say that there aren't, and we can talk about, if you want to have a conversation about, things that you can do with your cap table that make it more challenging for investors later on. There's certainly lots of things that you can do.
I've seen those.
Yeah. And are we going to fundamentally walk away from something just because of that? The answer is no. On the flip side, if something's really way off, is that going to play into our thinking? Well, of course it will. I think part of it's not just the situation itself, but then it's also reflective of, the CEO's ability to manage investors and their ability to execute.
Yeah, I mean, I guess I can echo from my own experience here. We've seen plenty of companies that that go into diligence with an investor with all sorts of problems. And, I don't think I've ever seen an investor just totally abandon the deal because of a problem like that. They're always trying to work around it. I've seen deals die because they couldn't figure out a workaround.
Yeah, that's right.
But I've never seen anybody not try to make the deal work. And there've been, I've seen a lot of deals with a lot of hair on them. So, that's. I'm sure you've got more war stories than I do on that front.
You're the lawyer. They come to you when there's something wrong.
Yeah, well, they usually come to me after there's something wrong, which is the problem. But okay, so let's get into sort of the term sheet stage. You get to the point where you decide you're interested in investing. Are you guys putting out sort of fairly vanilla term sheets? Obviously the dollar amounts differ, the valuations differ, but in terms of the overarching terms, do you want a board seat or observer seats? What kind of protections do you want? Does NextView sort of take the approach of, look, we're gonna take a pretty standard approach to all these deals. This is sort of our requirements, or do you mix it up a fair bit depending on the transaction?
Yeah, so I think first and foremost, we want to be aligned with our entrepreneurs and have a goal, have mutually the same goals. And so we have a preference for preferred equity rounds, but we probably about a third of our investments are some kind of convertible note or safe instrument. On the preferred equity rounds, we think it's beneficial for us and for the entrepreneur to have, to your point, as simple a structure as possible at the beginning, because that just sets the precedent for what's going to happen further down the road. And the more bells and whistles that you put in earlier, then the more bells and whistles later rounds of financiers decide, okay, we can stick these in here, and then that can become disadvantageous to us and then also the entrepreneurs. So we tend to use, we end up using the seriesseed.com documents as the basis for most of our seed transactions, and that is I'm curious. You're the lawyer here, but we tweak one or two minor things depending on what the situation is, and the challenge with complete templates is like not all situations are completely the same, but for the most part, we're trying to be as straightforward and I would say elegant as possible.
Yeah, I tell entrepreneurs that the last thing you want to be doing is paying me $25,000 to do your seed round. I'm happy to take the money, but it's just not the way you want to spend your capital. And so, you try to stick as close to possible to what's sort of considered standard terms.
Yeah.
It's a little harder at the seed stage because there isn't quite as much agreement on exactly what a seed term sheet should look like. I think partly because you have fewer institutional seed investors than you do institutional A-round investors. At the A-round, I think.
Well, what it is, it's the proportion of deals that get done by institutions
right.
is much higher at the later stages because of the amount of capital requirement. Yeah.
Right, and so at the A-round, I think 90+% of our deals are either based on the National Venture Capital Association standard documents or some minor variation on that you could tie back. You run a red line to those documents and you can see immediately what they've done.
Yep.
Seed stage, it's harder, and I tell investors the same thing, that we do represent some seed stage investors, some angel investors that really you don't want to try to get too cute.
Yeah, that's exactly the word I was going to use. You don't want to be too cute. Yeah.
So no, absolutely, and actually, I'm going to shameless plug. This is over in the comments already, but as part of our sponsorship of Startup Boston, one thing that I'm offering to anybody that's involved in Startup Boston is to review their term sheet. So if you get a term sheet from David or somebody else and you just want my eyes on it, I'm happy to spend a little time looking at it, giving you my thoughts on whether it's typical or not typical, and giving you my suggestions, all completely off the clock, no obligations.
That's
So,
great. That's great. That's a generous offer. I commend you for doing that.
Thank you. I appreciate that.
I don't want to be on the other side of that transaction.
Yeah. Well, I was going to say to you, you should just ask the companies that you find to send it my way, and I'll be nice. No, but look, I mean, we've the reason I think you've been successful is because you haven't tried to pull one over on investors. But I know that founders go into these. Some founders go into discussions with VCs. I want to say sometimes mildly paranoid, or at least sort of cautious, because you see or you hear horror stories about things that went, deals that went south, or investments where eventually the founder got kicked out for one reason or another. And there's always more to the story, but there's but that for a founder that creates heart palpitations. I'm curious, what do you see when the founders are coming to you and they're looking at the term sheet and they're going, what the heck is well, why in the world would I give you a veto over, selling my company or something like that? What kind of things are you seeing founders focusing on, and maybe more than they should?
Yeah. So first off, now I'm going to give you another plug, which is we recommend that founders always get great legal counsel, because that actually helps us in that process. If they don't have sophisticated counsel that understands venture term sheets, they can get advice that is, technically correct, but doesn't understand the dynamics which are at play. There are lots, to your point, there are lots of different terms within the term sheet, and in a Series C preferred round, and many of these are just they're standard. They're just standard for a reason, and they're not really that negotiable. And then there are some that are important terms and are very negotiable, and entrepreneurs should spend time over there. And so, I'll give an example. Entrepreneurs, there's a bunch of protective provisions that go with preferred, and those are usually fairly standard. Entrepreneurs sometimes have challenges with those, but those are not going to get negotiated that much. On the other place where entrepreneurs spend a lot of time focuses on valuation, which is a number. We can talk about that, but and that is negotiable. But there's another area where entrepreneurs can also negotiate a lot, but but affect them quite a bit, which is around founder vesting. I've seen founders spend all this time on the valuation. I wanted this number or that number, whereas the vesting schedule, and whether it's quarterly or monthly, and when it starts and when it stops and how many years it is, that's actually a very negotiable term and set of terms for VCs, and are willing to give in many cases, not a lot, but in more than whatever their first initial offer is, for sure. And sometimes it just doesn't get negotiated. And so having some sophisticated legal counsel that knows and does these types of transactions can actually help give you counsel, exactly the words. They're like, hey, these are the areas where there is going to be room for negotiation. And like, hey, here are the terms. I'm going to explain these to you. But these are kind of standard, and like, it's not worth using up your negotiation leverage to change this one term, whereas you could get so much more if you use that negotiation leverage over here.
Yeah, no, and I would say that it actually, I think maybe counterintuitively for a lot of people, but it actually ends up costing less to do a transaction if you can deal with those terms at the term sheet stage than if you have to deal with them at the document stage. Because once you produce the documents, you start negotiating things, pieces fit together, and you move one, and you got to move all sorts of other things, and it snowballs. And so, plus there's a lot more resistance to changing terms once you get to the term sheet stage. So it usually requires more negotiation. In your case, it may require going back to your partners.
Yep.
So if you can nail that stuff down at the term sheet stage, it actually ends up being a more efficient process from a timing and a cost perspective.
Yeah.
Yeah. I think that that value, generally I tell entrepreneurs that the terms typically fall into two buckets. It's either control terms or economic terms.
Yep.
And everybody focuses on the economic terms, particularly the vesting. They don't focus so much on option pools, although there's a little bit of focus on that, but that can be pretty dilutive.
Yep.
And they don't focus as much, not so much on. I see protective provisions, but that's usually, I say the same thing to them that you do. It's sort of like, look, the investors need their protections. It's standard. You're just not going to get anywhere with them. But board control, there's the typical, at least at the A stage, and I don't know, you guys, I'm guessing, end up with probably a 3 to 5 person board coming out of an initial financing, yeah?
It's usually 3 to 5. We have a preference for having a board seat. We ask for it. For us, it is actually less about the governance and more about having a voice at the company and establishing the tone to have a voice. And so, it is and I think you'll find, especially at the seed stage, that's where there's going to be a wide range of points of view. Some seed stage investors say, hey, we're seed investors, we're not going to get involved beyond being good investors, and we don't want to have a board seat. And then on the flip side, you're going to see some seed investors say, hey, I'm not going to make this investment unless I can have board seat and this amount of governance and control, and let's build all this in. And so I think the variance narrows as the company goes through different stages. A Series C company is gonna have the same kind of governance at the board level as most seed stage companies, but at the seed, you're going to see a pretty wide variation.
Yeah, I mean, we do see a variation, I'd say, and it depends on a bunch of factors. I think that the thing that sometimes gets missed is that you have to be careful not just about what the board is going to look like at closing, but also who has the ability to influence who gets put on the board later. I mean, one of the presumptions, I think, is the founder is going to be the CEO forever, and that's not always the case. And sometimes that founder loses that CEO position voluntarily or involuntarily, and suddenly the board, instead of being two founders and an entrepreneur, ends up being a founder and two founders and an investor, ends up being one founder, one investor, and one third person who might not be aligned with the founders and a lot of stuff. So anyway, it is, I think, an important topic at that stage. So actually, one more question on the term sheet stage quickly, which is, what's your expectation on timing from issuing the term sheet to closing? About 45, 60 days?
Yeah, I think I try to get it in 30 to 45. 45 is probably average. If it's getting out to 60, then something's shouldn't take
it. A snag and diligence.
Yeah. Time kills all deals, and I think if it's
I know, especially right now.
Again, we try to have our term sheets fairly straightforward, and so the move from term sheet to definitive docs to closing should happen it shouldn't take too long.
All right. So I'm going to move back to a couple of the questions that have cropped up that are that sort of cover some of the things we've talked about or next steps. One actually that I think is relevant is what role do you play post-closing? You're in the business, you've invested, maybe you have a board seat, maybe you don't, but in terms of how do you promote the companies? How do you help them grow?
Yeah, I think when you distill it down, founders, CEOs, they only care about three things, right? It's like getting customers, hiring great people, and not running out of money, right? I mean, like if at the end of the day, it's like if you can, and so we try to help in all three of those areas, right? So like we have someone at NextView is our head of platform that helps, that she gets up every day, Nicole, and thinks about how do I systematically help our portfolio companies, and that's along the lines of talent in particular, as well as other marketing efforts, in terms of recruiting, and we will sometimes help source candidates for companies. I will interview companies. Interview candidates. Sometimes I'll sell candidates that they're trying to hire. And then into the last point about not running out of money, I think one of the values that we, NextView, bring to the table as a dedicated seed stage venture capitalist is we work really collaboratively with the entrepreneurs in our portfolio to help them raise and optimize that next round of financing. We don't see the seeds. There are some larger multi-hundred million, multi-sector, multi-stage funds who play at the seed. And for them, the seed investment is kind of an option. Okay, do I want to lead the Series A? For us, majority of our time and capital is going in at the seed stage. And so we're then aligned with entrepreneurs. So let's figure out together how we optimize your Series A fundraising process. And the good news is, as opposed to entrepreneurs that do that maybe once, twice in their entire career, our firm, we have portfolio companies that are doing that literally, every month. And so we know the playbook on how to optimize your Series A fundraising.
So again, just trying to take on some of the questions that I'm seeing on the Slido presentation. Interesting question about, and again, I'm sort of going backwards here, but
yeah.
If we were talking earlier about how a team presents itself and tells its story.
Yeah.
How do you balance that right now, given the pandemic? So how do you say, well, as long as the pandemic's going on, we're doing X, but once the pandemic's over, we're going to be doing Y or something that does that? How does an entrepreneur approach that in terms of talking to you about, and frankly, making it convincing?
It's challenging. I mean, I think we ask ourselves anytime we make an investment, why now, right? And so, I think it is a challenging pitch to say, okay, we're doing this for 6 months, but when the pandemic is over, we're going to switch to something else, or we're going to then be able to do something more. We want to invest in a company that's going to be able to make strides sooner rather than later. And so, again, I think about some of the comments I made earlier about what are those businesses that the future is now pulled forward, and so that the why now is now, as opposed to the why now being 18 months from now.
So that might be one of those, not a no, but not yet kind of thing. If you can't make a compelling case that you can do something to make strides during the pandemic.
Yeah.
Okay. There's a question about accelerators, and specifically asking you and I to both comment on basically accelerators taking a small percentage of equity. In my experience, accelerators can be really helpful. So I've seen sometimes it works out great, sometimes it works out not so great. I think obviously it depends a lot on the quality of the accelerator, but the equity component seems to be pretty standard at around 6% right now.
Yeah.
I don't know what you're seeing and how that influences your investment.
Yeah, I actually think accelerators are a great on-ramp into kind of professional investor world. I mean, it's a little bit of finishing school. It's a little bit of actually helping to push the business forward, and it's a on-ramp into the tactics and strategy on how to fundraise. And I think, different accelerators, there's probably a ranking order of, which ones are the most effective versus somewhat effective. But I think 6% of a business, taking, how I'm framing it another way, 94% of a company that's going to be successful is a lot better than 100% of a company that just didn't work out because you didn't do the accelerator. I'm very pro accelerator. Yeah, no,
I think certainly for the ones out there that have a track record, 6% is a small amount of equity to give up at that stage. I think the problem is you have to make sure there's so many people out there. It feels like in the last 10 years or so, everybody started a new accelerator, and every time you get a new, it's like blockchain. Now there's blockchain accelerators out there. Well, they're really any good at accelerating your company? Maybe not. But the ones that have good reputations are absolutely worth the 6%.
Yeah.
The question about seed versus Series A, and I know there's no hard number cutoff. And frankly, we've done deals where, for whatever reason, even though it's a $750,000 financing, the entrepreneur really wants to call it a Series A financing because they want to be able to say they raised a Series A round. I've seen $3 million seed rounds. Obviously you are a seed round investor, but how do you think about that distinction?
It's all marketing, and that's all it is, and that's fine. That's not a criticism. That's actually a good thing, which is like, you call it a seed round, if you want to frame it as the next round, you want to raise a Series A, and you want to set yourself, you don't want to, back to being graded on a curve. You don't want to be graded on a curve if you've raised a Series A. You want to be graded on the curve of you was a seed. And then there are some cases you want to be able to pound the table and say, I raised the Series A and we're successful. We did it. And now I want to recruit this executive or this executive. And having raised the Series A will empower you, incrementally to do that. And so to me, it's about how much it's more about how much dollars are into the company, what the flavor of the investor set is, and then, how much time has been to the company. Yeah,
I was going to say that has a lot to do for me as to what the terms are. The more involved the preferred terms are, the more likely it really means it makes sense to be a Series A. Yeah. Look, David, I know that we're running out of time here and you have to hop, but any final words of advice or encouragement for the entrepreneurs in the audience?
Figure out how to tell a story. Investors make decisions with their hearts, not just their heads. And so the facts are helpful, but you need to tell the story.
All right. Well, thank you very much for your time today. Really appreciate it. Thanks to all the questions that were submitted and all the people online. If you have any follow-ups, I'm happy to answer questions offline.